Okay, good afternoon, everyone, and welcome to our timely webinar, The Middle East Crisis and What It Means for the Global Energy Markets. I'm Rob Thummel, Senior Portfolio Manager here at Tortoise. I think usually you see Mark Maruffian, but I'm filling in today, and this is going to be our ninth, I think, webinar since the crisis unfolded. I think it began on February 28th or so we're about 6 months in. So what we like to do for everybody is design these webinars to really unpack what's going on with the energy sector, really in real time. So before we dive in, just a quick housekeeping note: we will leave some time for Q&A at the end, so please feel free to submit your questions at any point in time. Okay, so if you're new to Tortoise, we are energy specialists with more than 2 decades of experience. Our senior portfolio managers have been working together for the longevity of that, and we have about $11 billion across the energy value chain, from wellhead to the end user. Now recently we've added a few new products, and today what we'll try to do is give you an idea what's been going on, really where we are with the war with Iran, on the macro front, and then how it's impacting the energy sector. And what you're going to hear a lot about today is, inventories, right? We like to find businesses that are operating in undersupplied industries where there's growing demand. And we do a lot of that with AI infrastructure. We do a lot of that in energy, and oil, and the fundamental commodities and natural gas. We're always looking at supply demand, looking to where the market's undersupplied. And because what we do know is that the demand for energy has continued to grow. It grows every single year. And what we've learned, I guess, throughout this entire crisis from a big picture perspective is oil is really important. And what you'll see at the end of this webinar is natural gas is really important, and we're really, really lucky here in the U.S. that we're effectively the largest producer of natural gas in the world. So let's go ahead and get started, and let's flip to the next page, and let's talk about energy exports. If you've been listening to us for a long time, you know how our view on energy exports. The U.S. is the largest oil and gas producer in the world. This has been a real advantage to us, especially during this environment over the last 6 months. And what we've also learned is there are several other countries that simply are going to have to rely on energy exports, or energy imports from other countries, and that the U.S. is well positioned to benefit from that, because the U.S. energy exports will continue to grow. And if you look at what's happened historically, and you think about and put this in context, the shale revolution, shale technology totally changed the game for the U.S. Globally from an energy perspective, and it's really had a profound effect. It now has allowed the U.S. to become the largest energy producer and of oil and natural gas, but also the largest energy exporter of oil and gas and other commodities. And you can see over the last really 10-year period, maybe 15-year period, on average, every year, compound annual growth rate, 11.6% increase in energy exports every single year, if you think about that. And so a lot of the investments that we're making in infrastructure, and have made and will continue to make, will support growing U.S. energy exports. And I think what countries around the world have figured out is that they need energy security. Well, how do you get that energy security? Well, you either produce your own energy, which a lot of countries aren't able to do, unlike the U.S., or you diversify your supply sources. And diversifying your supply sources means more exports from countries like the U.S. That are clearly reliable sources of energy supply. And so we think, and some of our central themes around a lot of our investments, whether it's in infrastructure or broader energy, is increased energy exports. And we'll dive a little bit more deeper into that starting on the next slide, of where those are going to come from. So if you look at, what do we export out of the U.S. right now? What this slide shows you, it shows you that same slide previously, but it just breaks it down by commodities. So we export refined products. So we started out in the U.S. exporting refined products, gasoline, diesel, jet fuel years ago. And we still do that, and we'll talk about that. And you can see that's expanded a little bit, but that's not where the U.S. has seen much growth in terms of exports. I think if you do a compound annual growth rate on that, it's right around 5%, maybe just a little bit lower over the last 10 years with regards to refined products. And the U.S. is a beneficiary of having some of the world's most complex and best refineries and a low cost of crude oil, whether it comes from Canada or it is produced domestically. And so that allows the U.S. to be a low cost supplier of refined products like gasoline, diesel, and jet fuel during a time period when the world really needs it. And talk more about that in just a second. As you can see, though, as the years have progressed, as more and more U.S. Oil and gas was produced, the U.S. began exporting additional, other energy exports to other countries. Also shown on here are LPGs or liquid petroleum gases like propane and ethane. Those have become really important to countries like India and Asia, and the area of Asia, because that's where you see a lot of demand for ethane and propane. Obviously, a few years ago, the U.S. removed, actually it's more than a few years ago now, maybe a decade or so, maybe even a little bit longer than that, the U.S. removed the restriction on exporting crude oil, and the U.S. actually has dramatically increased its exporting of crude oil. I think the crude oil exports have increased on average or on a compound basis by about 40% a year over the last 10-year period. And then, of course, the one that everybody is familiar with is natural gas. We'll talk more about that in a second, but natural gas is the huge competitive advantage that the U.S. has because of the low-cost nature of the natural gas that the U.S. produces. And countries all around the world just simply haven't been able to replicate this. And what we do know from the war is there has been a substantial change in the fundamentals in that the Strait of Hormuz has been impacted. It's gone 6 months or maybe without significant activity. And so what happens when you don't have a lot of activity out of the Strait of Hormuz, or you don't have ships that are bringing large amounts of oil and gas from the Strait of Hormuz to destinations? Well, you have to turn to inventories. And so let's talk about what's gone on in inventories, because I think this is really one of the stories. And if you're not invested in the energy sector, I hope after you get done seeing these inventory numbers, you'll relook at the sector. I know that a lot of people have been underallocated to the energy sector. We've been getting a lot of calls from advisors about how to invest in the energy sector, especially more recently as this war continues to move on and on and on, and that's because inventory levels are going lower, both gas, oil, and refined product, and that's going to that's going to be a positive for a lot of the energy companies we're investing in, and they're going to benefit from that. So let's move on to the next couple pages. Skip to page 7, and let's talk about crude oil inventories globally. I think this is people were ready to write off crude oil a few years ago, and I think what this war has demonstrated and the closing of the Strait of Hormuz is, look, oil is still really important. I was talking to a Wall Street Journal reporter the other day who was in Dubai and that I've known for a long time. And, I as an investor in energy for 30 years, I never would have thought that the Strait of Hormuz would have been closed. It's never been closed, obviously, in my 30 years of investing in energy. And it now has been closed for a little while. And we'll see what happens with it going forward. I don't think it is closed indefinitely, but right now it's effectively closed. And you can see here what the impact has been because of the closure of the Strait of Hormuz. And that's been a dramatic decline in crude oil inventories. And what's important here is two things. Crude oil inventories are basically at all-time lows globally. But when crude oil inventories are low, often that means that prices move higher in any commodity or for any good, or really any good. So crude oil inventories have continued to move down. They're at all-time lows. They're going to need to be replenished, and so we're going to need a lot more production. And a lot of the companies that we're investing in, both on the infrastructure side as well as the non-infrastructure side, are going to benefit from increasing the crude oil crude oil production, so that we can refill some of those inventory. If you flip a couple slides forward, Gabby, to slide 9, you can see a lot of those inventories. We also show you how crude oil inventories on. If you go one more slide, I think it's one more slide. Are you on slide 9? I'm sorry, slide 9 is what I meant to say. Crude oil inventories with the Strategic Petroleum Reserve. When you look at the Strategic Petroleum Reserve, we all know that's been whittled down and reduced in an effort by the administrations to reduce crude oil prices, and so we're going to need to refill that. And you can see we're 17% below, almost 18% below the average, basically, below the 5-year average. And so the energy in general, we need more crude oil produced in the world, and we need more crude oil pipeline basically and stored in these storage tanks. And so we're going to see that over the next year or two. It's going to take a little while, and we've talked about on previous podcasts how much longer it's going to take. In these webinars, we've shown you and illustrated to you how long it's going to take to refill these inventories. And so we're working on that, and we'll see that happen. But in the meantime, the companies that'll benefit are all these low-cost U.S. producers that are producers of oil, and all these pipeline operators that are transporting the oil, because we're going to see higher volumes or equivalent and higher volumes move through those pipelines, and the fees continue to move higher, and then obviously the crude oil volumes at the producer level move up as well. Okay, let's go to slide 10 and flip and talk about refined product. This is something that's on everybody's mind. I know. I mean, I get this question a lot, especially from my family. Is crude oil is down. I mean, crude oil's up for the year, higher, but frankly, with crude oil where it is, I'm really surprised since the Strait of Hormuz is closed. But yet, refined product and gasoline prices have moved up somewhat. I think gasoline prices are up 37% or so, 40%, I believe, if I got my number right, since the war, and crude oil prices are up maybe a little more like 15 or 20. Why is that happening, and who does that benefit? And this slide tries to show you what's happening. And if you look at what's happening with refined product inventories, similar to crude oil inventories, refined product inventories are below normal. They're below the average. They're below the 5-year average. They're about I think we show on here 6% below the 5-year average. And the reason for that is because if you think about what's going on and where does refined product come from, obviously we produce a lot in the U.S. and we're really, really fortunate that the U.S. has some great refineries that produce all of our own gasoline, diesel, and jet fuel. Because if we didn't, the gasoline price would be much higher. But because the existing U.S. refineries are producing so much oil and gas, so much refined product, we've been able to maintain our inventories without them slipping too much. The reason why the inventories have slipped is because Russia used to, what was and still would be a large exporter of refined product to the U.S. and other areas around the world. And obviously with the bombing that's going on with the drones from Ukraine, a lot of the Russian refineries are no longer operating, and so as a result of that, you're seeing a decline in the spare capacity in the world for global refineries. And so that is also combined with the Chinese teapot refineries. Many of you, longtime listeners, have heard us talk about the teapot refineries in China that historically would look at the refining spreads and the refining margins and would be eager to increase the volume of production of whether it's gasoline, diesel, jet fuel. They are no longer really doing that because the Chinese have had to move to using their crude oil inventories, and then as a result of that, they are maintaining and keeping the refined product, the diesel, the jet fuel, and gasoline in the country to try to keep the costs down, right, and keep inflation from rising dramatically in China. And so the net result is the world's turned back to, well, who else? Well, the U.S. and look to the U.S. to fill in. And the U.S. has responded. It can't fill in all for everything, but the U.S. has responded pretty strongly in refined products, and that has been a real beneficiary to a lot of the U.S. refiners. And if you look at where we've been positioning our portfolios on the non-energy infrastructure side, on the broader energy side, we've been looking at for the past, probably 6 months, adding to our refining investments, because the margins, the refining margins that these refiners are earning are tremendous. They're exporting a lot of refined products out of the country. and the net result is significant cash flow and really high free cash flow yields, which is what a lot of the refiners have benefited from, and that's really helped drive up the prices of the or improve the stock prices of the refining stocks. Okay, oil exports, real quick on the next page, page 11. I think we're on page 11. You look at that. That's. I'll just spend a little bit of time on there. That if you think about, well, why is there demand for crude oil exports? Well, U.S. oil prices are lower than international prices, right? So the international Brent oil international oil prices are measured by Brent crude oil. Those prices, I think, are about a $6 premium right now to U.S. prices. So this would encourage more exporting of U.S. And you can see from the chart, we've dramatically increased out of the U.S. our crude oil exports, and then those exports will continue to grow, we think, well into the future. And several investments we're making are investing, whether it's in pipelines or terminals and storage facilities. They're building up the infrastructure and the logistics that are required to continue to export more and more crude oil, because the world is going to need more and more U.S. crude oil, and it's frankly cheaper than what the global crude oil price is. Okay. The next slide gives you a perspective on refined products on slide 12, where we are in the world today. As I mentioned, we are low on inventories, so globally, and so the natural reaction, as I mentioned earlier, was, well, the U.S. steps up their game. And if you look at, well, what does that mean? That means higher utilization rates of U.S. refineries. So historically, the utilization rate for U.S. refineries has been about 89%. They operate about 89% of the time. Right now, they're operating at 97.2%. We don't have a lot of margin for air, guys. We don't. I mean, well, we got to hope that we don't have a strong hurricane season this year and have some of those refined product or some of those refineries on the Gulf Coast be impacted, because we would see higher gasoline prices if that was the case. I hope that's not the case for any of us, because we just don't have any capacity. We don't have any margin for error right now in the refining space, and none of us want to see much higher gasoline prices. Affordability is going to be really important to all, or affordability is important to all of us, including us here at Tortoise. And so the U.S. does have plenty of crude oil. The world has plenty of crude oil. We just need to be able to get that crude oil to move, and we need to continue to get these refiners operating around the world. But in the meantime, U.S. will continue to do its part and then some, and probably produce, like many of the refiners did, at above nameplate capacity, so over 100% over the next several quarters, in order to keep this world supplied with gasoline, diesel, and jet fuel. Okay. Let's talk about. I always tell people, if you're looking at crude oil, you got to look at the curve. I think the curve is always important to visualize, and the shape of the curve will tell you a lot about where we're going. What does this curve tell you? Well, the dark line shows you the futures curve. I think it was a couple days ago, and it tells you it's backwardated. In other words, the current prices are much higher than future prices. So this curve would tell you that the futures price of oil, maybe a year from now, could be back to be back down into the 70s, and maybe even below the 70s, which could be possible if we can get this oil to flow, because of the higher level because of the amount of oil we have in this world. You can also see, though, the curve has kind of changed. It has evolved over time. The dotted line was the crude oil curve right before the start of the Iranian war. And so it was pretty flat, right around $65. But you see, the whole curve has moved up about $10. On average, basically, the whole curve's moved up maybe $10 to $20, right? And so now what we think is we're going to see you see oil prices with a lower floor. They're probably going to be, rather than $65 was the floor, maybe it's 70, maybe it's 75. Once again, this is another reason why we've been telling investors, if you're underallocated to the energy sector, I really would encourage you to take a second look at it, because we do think that you're going to see higher oil prices for longer, not outlandish oil prices that are going to stunt an economy, both globally and domestically, but oil prices are going to be higher, and some of the oil producers are going to benefit. Of course, our energy infrastructure companies will, because of rising exports and just increasing demand, will continue to benefit. And then things like the refineries are going to benefit as well. All right, well, we'll wrap up here fairly quickly and start looking at natural gas, though, because natural gas is really interesting. I've spent a lot of time on television lately talking about natural gas because one of the things that many of you know is that the U.S. has a huge competitive advantage in natural gas. The U.S. Produces all the natural gas it needs and then some. We're a net exporter of natural gas. We have been for a while. And the second largest net exporter of natural gas or exporter of natural gas, Qatar, its facility has been damaged as part of the war. And it's not coming back for several years. And so the result of that means is there's going to be some significant opportunities in the U.S. for U.S. natural gas producers. So if you look at the next slide, now you look at what natural gas prices have done. Well, since the war started, believe it or not, and you might not believe this, but natural gas prices actually on a spot basis have declined by 6%. So they're 6% lower than in February. Why is that? Well, it's part of it is shown here on this slide, on slide 15. You can see that natural gas storage, for the most part, is in line. Actually, we're more than that. We're more than in line. We're higher. We're about 6% higher than what we've been historically. And when storage, we just talked about, well, when storage is lower, obviously prices are higher. When storage is higher, net prices are lower. And so that's what we're seeing in natural gas. Now, if you look at across the U.S., natural gas prices are below $3. That's just a phenomenally low level, and that's why the U.S. has this competitive advantage globally, because European natural gas prices are near and above $20 for the same unit of natural gas. And so as a result of that, they're 8 to 10 times higher than what we are here in the U.S., which is a huge competitive advantage, especially in this environment that we're in right now. Because if you look at the next page, Europe, because of the high natural gas price in Europe, the Europeans have called upon a lot of their storage, and normally they're refilling storage this time of year. And so you see natural gas storage levels in Europe at much higher rates. They're not. They're near the lows where they have been in the past. So what this tells you is Europe is going to continue to import a significant amount of U.S. natural gas. So U.S. LNG exports are going to continue to rise. They're going to continue to rise pretty significantly. And the price differential between the U.S. and Europe will probably stay fairly wide for a while. So who does that benefit? Well, some of the core, obviously from our perspective, the natural gas infrastructure names will continue to benefit because there's needs to be movement of natural gas to the Gulf Coast and other areas to export this natural gas. But there are companies that also export natural gas like Cheniere and Venture Global that benefit from the higher European prices relative to the U.S. prices as well. And so because of this low European natural gas storage, it's about 20% below where it was. We still continue to expect that Europe will experience higher natural gas prices. The net result of that is on slide 17. You've seen the exports of U.S. LNG. We continue to expect U.S. LNG exports continue to increase. They're about 36% higher than they were, I think in August is what we have on here. So the U.S. LNG exports continue to increase, and that's not going to stop. Natural gas is such an important global commodity. It's become really important globally. We think it's going to gain even more prevalence globally as electricity becomes the new oil, and then natural gas is the primary fuel that generates electricity. And you're going to need, and the way you're going to win this global AI race here in the U.S. is because of this low-cost natural gas that we have in the U.S. And so we got a couple more slides to go through. If we look at slide 18 and you look at the curve for natural gas, which I always like to look at, you can see it's really unchanged. So there's not a lot on the horizon that the forward curve and that market and the prognosticators and the traders of natural gas really think it's going to change the demand or supply of natural gas dramatically. The price really from a Henry Hub perspective, the point here is it's probably going to stay pretty low in the U.S. So if we want to manufacture more do more manufacturing or industrial activity? I know there's a lot of that being considered. Well, the U.S. is going to be a great place to be because natural gas is one of the primary fuel supply sources for manufacturing and industrial activity as the fuel supply source. Refineries also use a lot of natural gas to power the refineries or to fuel the refineries and operate the refineries. And that a competitive advantage in natural gas in the U.S. extends to the refining sector as well, allows the U.S. to be even a lower cost refining producer because of that. So that will be a benefit well into the future as well. And then if you look at the last couple pages, if you look at the TTF, which is effectively the equivalent of European natural gas prices, you can see that curve, that forward curve, which is the darker line today, is much higher in the near term months, obviously representing over the winter. So that's why we still continue to believe in long-term LNG, well, short-term LNG as well, but also long-term LNG. We expect that the LNG producers will, and the LNG shippers will continue to do well here in the short term as a result of this widespread between global or between European natural gas prices and U.S. natural gas prices as well. And that also assumes that we'll have a normal winter and not an early winter and a normal hurricane season, not an abnormal hurricane season. If you're paying attention and see hurricanes or an early start to winter, you're going to see this natural gas spread widen out quite a bit, as well as seeing natural gas prices rise pretty dramatically. So I think that's all we've got for today for this update. We appreciate your interest, and I will turn it over now and see if we have any questions. Okay, let's see. Okay, can you guys just still hear me? Okay, I think you can still hear me. How much negative impact on data center constructions will Democrats' war on data centers have? Well, we follow that very closely here, Tortoise. I'm sorry, I'm going to put on my glasses to read these questions. Good questions. You always have great questions. We appreciate them. I don't think we are investing in companies that we think are actually providing some pretty elegant solutions for data centers in terms of what are the biggest concerns. Two biggest concerns: water and higher electricity rates. Water, there's been some reports put out that would show that the data centers are really implementing some highly sophisticated liquid cooling type of systems that really recycle the water in a closed loop system that reduce the amount of water that's needed. And so I think that just needs time to be proven, and I think it will be, and I think that will help alleviate that concern for data centers. Now, electricity, that's a question that for all of us, right? I mean, we all don't want to see higher electricity rates to support Meta and Google and Microsoft and as they build data centers. That's where companies like one of our largest investments, Williams, is operating, and they're providing this elegant solution called behind the meter. You've heard us talk about it before, where they basically Williams uses their large natural gas pipeline system and to build natural gas generation close to the data centers, and then they enter into a contract for that power generation between themselves and one of the large hyperscalers. They have been very active in that market and continue to be. And we're going to have a chance to talk to Williams here and then later in the fall and firsthand perspective from them about how they are providing this solution and how big they think this opportunity could be. You've seen their growth rate and their underlying dividend or potential, and sorry, and their underlying EBITDA grow to double digits because of this opportunity. Okay, another question that I appreciate. When do you see diesel or gasoline shortages, refined products in real crisis? Well, I would say we would already have been there if it wasn't for the U.S. I mean, I think that's a great question. I don't think we're going to see fuel shortages. I do think that one of the great things about I guess it was a great thing about the pandemic and everything shutting down is a lot of these refineries were able to take some time, slow down. Demand was down. They could go in and they could do the maintenance that they needed. Maybe they and some of the refineries I think even expanded just a little bit. And so I don't think we're going to see shortages of diesel or jet fuel because of that, because the refiners are going to continue to operate these refineries. They're really high quality operators, but I do think we're going to see higher prices, and unfortunately, I think the higher prices are here for a little while until we get the Strait of Hormuz open. Next question is, the administration is making a lot of claims about the amount of oil and gas getting through the Hormuz that do not seem to be backed by evidence. What's Tortoise Capital's view on the amount of energy getting out, and how close are the shortages in Southeast Asia, Europe, the traditional destination for oil and gas from Hormuz? Yes, we would agree. I don't think as much as is getting out. I don't know what the latest estimate is. I know today was some thought that we were going to get the Hormuz. There was some talk about getting Hormuz open back up and fully operational. We're just simply going to have to get there through some type of a diplomatic agreement. I don't know how exactly right now, but we're going to have to come up with a solution. I mean, the world needs the Strait of Hormuz to be open. It can't be closed indefinitely, or the economy is going to suffer. But now that said, back to the second part of this question. The rest of the world's going to hurt more than us. China, India, large consumers of oil, and then and then Europe, from an oil and a natural gas perspective, are really going to be hurting because of the lack of domestic production in those countries. And so we do think that the U.S. is still well positioned relative to these other countries from a cost of fuel perspective and a cost of oil perspective. Okay, the last question I see: the strait has been closed for some time. Oops, where did it go? Okay, here it is. And why is oil only at $80? Or what are we missing? Yeah, I think that's a great question. That was a question from the Wall Street Journal the other day that I got, and I think the oil is only at $80 because of we got to all thank the U.S. shale producers, because we've got a lot of U.S. oil production that's really helping keep oil prices down globally. So if you think about it, you go back, the U.S. shale produced a lot of oil for years and years and years, and so did the rest of the world. We built up these inventories to high levels, and now we're starting to deplete these inventories, and we've got the ability to bridge ourselves through inventory through this crisis right now. And we're going to have to get the straits open back up, but the oil price can stay low. There is plenty of oil in the world. We just have to get it moving. And then another last comment possibly is, or last question is, please comment on physical oil markets pricing being much higher at $140 versus financial markets in the 80s. Yeah. So, well, that could be a function of a variety of things. It could be the quality, the type of oil that's being demanded and needed. Because, as you know, whoever's asking this question knows these markets probably pretty well. The type of the type of oil that's needed in certain refineries or certain as a certain raw material is not the same everywhere, and so certain types of oil could be in much more scarce supply, which then increases their cost, and that could be why we have a disconnect between $140 oil and oil now in the 80s from a financial perspective. But okay, and then the last one: what does this imply over the next 6 months? Risks or positives, or where to profit other than refiners? Yeah, well, when you look at where we're investing from a Tortoise perspective, you would have seen us investing in refiners lately. You would also see us investing in some of the oil producers, the Exxons, the Chevrons, the Diamondbacks, because we do think the oil prices are going to be higher, and that you will see higher oil prices or higher oil production basically out of some of these U.S. producers, including some of the large ones going forward. Although it's not going to be dramatic yet, but you will. But the majors like Exxon, Chevron, Conoco, they will all benefit from higher oil prices, and then obviously they all own some refiners as well, or refineries as well, so they benefit from those higher refining margins as well. Okay, I think I don't see any more questions popping up, and I don't hear anybody telling me there are any more. So I will just close it out and say thank you all for attending this webinar. We hope you gained something out of it. We're always interested in your feedback. As you know, Tortoise, we want to be your energy experts. We have a large bevy of institutional or of retail and institutional salespeople that would be more than happy happy to funnel our questions to one of our portfolio managers, and we look forward to seeing you next time. And thanks again for your time. Thank you.